Picture the richest person in your town. There's a decent chance they own a construction company. You've seen the cranes with their name on the side, the fleets of trucks, the contracts worth tens of millions. From the outside, it looks like a machine that prints money. But here's the strange part. Of every $100 that roars through that machine, the owner might keep 2, maybe 3. And in a bad month, they keep nothing at all. Because the business that looks like a fortress is actually a house of cards, and the owner spends every single day just trying to keep it standing. Construction is one of the largest industries on the planet. Around $17 trillion flow through it every year, enough to build whole cities from nothing again and again. It employs nearly 1/10 of the workers on Earth. And yet contractors almost never go bankrupt because they run out of work. They go bankrupt because they get too much of it. That sounds like a paradox, the kind that has swallowed companies winning award after award right up until the week they folded. To understand how something this enormous can be this fragile, you have to stop looking at the contract and start following the cash. Because in construction, the money you've been promised and the money actually in your bank account are two completely different things. And the gap between them is where companies quietly go to die. So let's build something. Say you win a contract to put up an apartment block for $10 million. Congratulations. On paper, you are a millionaire. But before a single tenant ever turns a key, you have to spend. You buy the steel, the concrete, the lumber, upfront at whatever this week's price happens to be. You fuel the excavators and you lease the tower crane by the month. And every Friday, rain or shine, working or waiting, you pay your crews. Dozens, sometimes hundreds of people who need a paycheck, whether or not you've been paid. So the money pours out of your account from day one, in a flood. But the money coming back in? That barely trickles. The developer pays you in stages, and only after an inspector walks the site and signs that each stage is truly finished. Those payments land weeks, often months, after you've already spent the cash to do the work. This is the working capital lag, and it's the quiet engine humming underneath every collapse in this industry. You are always paying for next month's building out of this month's empty pockets. Now here's where it turns cruel. When the developer finally does pay, they don't hand over all of it. On every single payment, they hold a slice back, usually 5 to 10%. And they lock it in a drawer until the whole project is finished and signed off, which might be a year away. Or 2. This held back money has a name: retainage. Officially, it's there to make sure you finish the job and fix any defects, and said out loud, that sounds fair enough. But now remember your margin. After you've paid for everything, labor, materials, fuel, equipment, insurance, your own salary. A general contractor keeps, as actual profit, somewhere between 2 and 5% of the job. So look closely at what retainage really does. The client is sitting on 5 to 10% of the money. Your entire profit is 2 to 5%, which means the cash locked in that drawer isn't your profit plus a cushion. It is your profit. All of it. Every dollar you were ever going to earn on that building is being held hostage in someone else's account. And you cannot touch it until the very last inspection clears. And you can't just wait it out with money in the bank because there's rarely much money in the bank. This is a brutally capital-hungry business. The cranes, the loaders, the trucks, they cost millions, and whether they're roaring or parked in the mud, they're losing value and eating payments. To even bid on the big jobs, you have to buy a surety bond, a kind of guarantee that you'll finish. And the bonding company, like the bank, is happy to back you when times are good, and quietly pulls the line right when you're stretched thinnest. So how does anyone survive this? They do the one thing that feels clever and is secretly a trap. They take the deposit from the next project, the fresh cash a new client hands over just to get started, and they use it to pay off the crews and suppliers from the last project. Then the project after that covers this one. It becomes a chain, each new job quietly funding the debts of the one before it. Keep enough new work pouring in and the chain holds. From the outside, it looks like a thriving, unstoppable empire, which is exactly why growth is the most dangerous thing that can happen to a contractor. It feels like winning, but every new project is bigger, demands more cash up front, and digs the hole deeper before it ever pays you back. As long as the next deposit is always a little larger than the last debt, the house of cards stands. And it can stand for years, tall enough to fool the owner, the bank, and everyone watching from the street. There's a second trap wrapped around the first. To keep the work flowing, you have to keep winning bids, and you win bids by being the lowest number in the room. So there's a constant pull to shave your price to the bone. A little more for a little less. Bid too high and you starve. Bid too low and you win the job that ruins you. Every signature is a bet on prices you don't control, months before you'll pay them. And then, one day, someone pulls a card. Maybe the price of steel leaps 30% between the day you bid and the day you build. And you can do nothing because you promised a fixed price. Maybe a permit stalls and the whole site sits frozen while you keep paying rent on idle cranes and crews. Or maybe one big developer near the top of your chain simply doesn't pay. Goes under, still owing you millions you already spent. Any single one of these and the next deposit no longer covers the last debt. And because every project was secretly leaning on the one behind it, they don't fall one at a time. They come down together in a matter of weeks. Suppliers stop delivering, crews walk off, half-finished buildings stand open to the sky. The company that was winning contracts last month is being auctioned off for parts, and everyone asks how a business with a full order book could possibly have gone broke. If you're tempted to think enough money would fix all this, consider Katerra. It was a construction startup backed by SoftBank, handed roughly $2 billion in venture capital, and told to reinvent the entire industry. Its own factories, its own supply chain, technology end-to-end. $2 billion of runway. And in 2021, it filed for bankruptcy and simply vanished. Not because it couldn't get work, and not because it ran out of ideas, but because no amount of money rewrites the physics. Thin margins, prices you can't control, and one delay too many will drain $2 billion just as surely as they'll drain 20,000. So what actually separates the builders who last from the ones who vanish? It turns out it was never the size of the contracts. It's whether they have any control at all. Control over price. So a spike in steel is an annoyance, not an execution. Control over cash. So a slow-paying client is a nuisance, not a noose. The ones who survive keep less work on the books, but they own their equipment. They hold cash in reserve, and they walk away from any deal where the numbers only work if nothing goes wrong. They are almost never the flashiest names on the tallest towers, because the flashy number, the $10 million contract, the record year, the skyline full of cranes, was always a story about revenue. And revenue is just money passing through on its way to somewhere else. What actually keeps a company alive is what's left after it passes. Whether the cash converts into real profit, whether that profit earns a decent return on everything you sank in, and whether anything protects it from the next bad shock. Construction is simply the most honest teacher of this lesson because it hides none of it. And that lesson reaches far beyond construction sites. Almost every business wants you to look at the big number on top, the revenue, the growth, the headline, but underneath they're all playing the same game the contractor plays. Can you set your own price? Does the cash actually turn into profit? And is there a moat deep enough to hold when the next storm rolls in? A company without those things is stacking cards, no matter how tall the tower climbs. A company with them doesn't just survive the storms that flatten everyone else. It compounds straight through them, year after year, quietly turning other people's disasters into its own advantage. The tower that lasts was never the tallest one. It was the one built on something real. And that's the difference between a fortune that prints and a fortune that only looked like it did. This video is sponsored by MoatScope. Construction is exactly why it matters. Everything we just covered, moats, compounding, quality at a fair price, is simple in theory. Actually finding those companies is the hard part. That's what MoatScope is built for. It rates thousands of stocks on the two things that matter most: how strong the moat is and what you'd pay for it. Quality times valuation, so you can spot the widening moats trading at a fair price. Check out MoatScope at the link below and find your next compounder.